I sold HYLD, and in this video we're going to talk about exactly why I sold it, the funds I'm looking at getting into in place of that portion of HYLD that I sold off of. I'm also going to open up my portfolio a little bit. I think it's about time. I haven't shared anything quite yet. I'm not going to go full blown into it, but I'll give you some percentages and to show you guys actually how a combination of HYLD and XYLD in combination together have performed against the market so far this year. Okay, so with that out of the way, let's go into HYLD. We'll do just a little brief pickup here on what exactly this fund is. I like to call it the darling fund of Canada. As far as covered call ETFs are concerned, it is an ETF, exchange traded fund, that holds other ETFs. So we can see here it holds the two big JP Morgan funds and the three Global X funds. These five are probably the biggest that come out of the States. We also have some other ETFs by Horizons, Harvest, and CI. These fund managers are Canadian, but they're invested in US covered calls. So again, this is a US centric covered call ETF, with the fund manager in Canada, with some of the funds that it holds are also Canadian, invested in the American stock market with covered calls on them. And then anyway, so basically all I'm saying is just a mixed bag of covered call ETFs. Okay, so to get a little bit into my portfolio and just to show you all what it actually looked like before the sale, I'll bring it up here. I bought HYLD back in probably early November. Since then, I've been reinvesting it inside my TFSA, and just recently I sold it as of recording here on May 20th, maybe about a week and a little bit ago, I sold it, a portion of it, and at the time it's done about 10.45%. You can see a weighting between the two funds. It's almost at 55%. I bought XYLD back in August of 2022. Earlier in 2022, the fund was probably at $51. I probably got in around the mid 43 and 50 cent range. It continued to drop after that, probably to a low of $37, and only recently, within the last few weeks, it's recovered back up to about $41. So again, total return, which is the price action of the fund and also the dividends that are reinvested into it. So just keep that in mind, the weighting of 55, almost 55% and 45%. This is what, after the sale, this is what the proportion looks like now. As you can see, it's almost like a reversal. XYLD at 58% and HYLD at 42%. XYLD is in my RRSP. I'm not too sure how, if I'll diversify that. I'm not too sure yet, but at least for my TFSA, I'm pretty well certain what I'm going to do with it. HYLD by far will be the biggest holding. I'm going to keep roughly a 50% allocation to HYLD, and everything else I invest in will make up the other 50%. How has that combo done in the market thus far? Well, if we go into Wealthsimple here, which is another really awesome, easy to use platform. It's costs about $11. You can get it for free, but it opens up other features if you get the pro version, $11 a month, which I really like, especially the performance, the capital gains tracker, income tracker, and just the total return tracker. And this is one of the total return trackers here in performance report. You can see since January 9th, since I joined Wealthsimple, we can see how the combination of these two funds have been doing. Again, total return, I've been reinvesting all of this money ever since I got into it and contributing to it as well with every bi-weekly paycheck that I get. So how does it stack up against other big indexes? Well, I mean, the biggest premier one is the S&P 500. How has it done year to date? Well, we can see that the S&P has been much more volatile than the two funds. Now, historically speaking, I did a video on this, how have covered calls done over time from 1986 to 2011. the cover calls are pretty much in every scenario are less volatile, a lot less severe up and a lot less severe down. So that just kind of goes to show here. I think my biggest gap was probably around this point on February 2nd, but over time kind of closed that gap. And as of today, on May 20th, the S&P is up 9.62%, and my combo portfolio is up 8.27%. Now, how has it done against other indexes? Well, let's see the Dow Jones. You can see the Dow Jones is at, 8.88%. The TSX, which tracks all Canadian companies, the Toronto Stock Exchange, we see 4.67%, but the NASDAQ blows all of us away at 21%. With the performance out of the way, a little bit of exposure to what HYLD is, let's get into the funds I'm actually looking at buying, which is very exciting for me because I've just had these two funds for the last 7 months. And yeah, time to diversify. Reason being, my wife and I were at one time earlier this year, we were debating on selling our place in the summertime, and I would have diversified at that point. We decided to stay put. So with that being said, I had to make the call to sell off something. So it was either going to be XYLD or HYLD. Not too many options in that case, but HYLD I think was ultimately, as my TFSA is the main focus, and I let my XYLD drip inside the RRSP. HYLD was, I think, I was better suited to just trim down a little bit and look at diversifying into other funds. Now, diversification. I'm sure if you've been in the investing space for a while, you've probably heard of, don't put all your eggs in one basket. Well, what about the hands holding all the different baskets, or the people with all the hands walking around carrying all the baskets? That's kind of how I like to think of diversification in a way. I like to have not just two fund managers, which currently are Global X and Hamilton ETFs. I want to get into other fund providers in case something happens to one of them. Well, something could very well happen to a Global X or Hamilton ETFs or any other one of those. So I don't necessarily, again, want all my eggs in one basket. I want multiple baskets and multiple hands carrying those baskets. Okay, so with the idea of that diversification anyway, actually, and there's one more style of diversification which isn't necessarily the primary drive of me wanting to get into different fund managers, but something of note as well is the diversification of investing styles. So we would have systematic, meaning the cover calls follow pretty much the same rules every single month, or active, where the fund managers can come in and just kind of tweak things. If they see opportunities in the market, they can pounce on that. So XYLD is very systematic. HYLD holds a lot of different of those styles between active and systematic. HYLD in of itself is actually more of an actively managed fund. They put in certain ETFs and they take away certain ETFs and they change the weighting as well. So actively managed in that regard. I actually like the idea of having both in case there are opportunities to be had. Okay, so when I talk about the other funds, I'm just going to be talking about the diversification. If you want to know more about those funds, go to the fund websites. As always, I'll provide the links down below for you in that regard. So the first one's going to be Harvest. Harvest has a bunch of ETFs that are also managed by Harvest, and you get exposure kind of all over the place here. US banks, which could very well break out once this debt ceiling stuff has been resolved. You got healthcare. Again, it's all these ETFs that hold other ETFs. They're some of them are going to be global in nature, North American in nature, just a total mixed bag across the entire spectrum, and you get the different weightings here and the different sector allocations. Okay, the next up is BMAX, and BMAX holds a lot of Brompton funds, right? So very similar to Harvest, or HDIF, I should say. It is a ETF that holds other ETFs, and here are all the funds it holds. You get exposure to cover calls, split share funds, other income producing instruments, and again, global in nature, North American, across the world, every sector. and different investing styles. Okay, so those would be the two, and both of them yield in the kind of 10% range. The next step is to get more Canadian focused exposure. We, as Canadians, we love our dividends, and also the sector of Horizons, Canadian Oil and Gas Equity Covered Call ETF, ticker symbol ENCC, with a juicy, monstrous 14.32% yield. I've had my eye on this one for a little while now. Invest in 10 different oil producers and pipelines. Now, this fund has actually gone through a bit of a change in the last year, right around, I want to say, kind of mid-2022. Overall, it's an older fund. It had a different ticker symbol. I think it was HEE at the time. So in mid last year, it changed to ENCC. It only held oil producing companies, but it mixed it up and also offered up pipelines just to reduce the volatility in it. And in a way, it rebranded itself. And maybe in some aspects, you could look at it, it's kind of a new fund in a sense, partially. But this is a way of getting just total exposure to the Canadian landscape. This would be probably the first all-Canadian ETF that I'd be getting with ENCC here. And the next one up, again, going kind of back to the original well of Hamilton ETFs, this HMAX holds a bunch of Canadian banks and insurance companies, has around 14.3% yield, which helps make up for the slightly lower yield of HDIF and BMAX. Not that those are great yields by any measure, but this just helps just sort of bring up my overall average yield. Okay, so looking at that, I know I'm not exactly diversifying with the financials aspect, but yeah, I actually have had my eye on this fund for a little while. And then these two other funds, Evolve US Bank's Call, again, it's been on my watch list for a little while, and you can see that in Blossom if you follow me. If you have, for me, this would be a short-term play. I wouldn't be doing this for the long term. It would be for the potential bounce with US banks. I know Warren Buffett actually got rid of a lot of US banks recently, but I think his thinking is no matter what comes out of the banking sector in the US, there's probably big regulation changes to come, and that may affect profitability for the long term. But for the short play, this might be a decent play for myself. Not financial advice, but that's just what I'm thinking of doing. I'm just going to keep my eye on this. We'll see what happens with the debt ceiling negotiations. But there might be an opportunity in the next week and a little bit just to get in, maybe get out, make a little profit. But again, I wouldn't be investing very much into this. My main focus is to invest for the long term. And the other play, maybe more of a longer term play, actually might be for, actually, you know what? For the US bank one, I forgot to mention, it's at like a 14% yield, I want to say. Let's go down. What is it at? Yeah, almost 14%. That's important. So, if you want to keep it for the long term, I mean, you're getting a pretty nice yield out of it at 14%. I don't want to miss that, because as income investors, yield is obviously one of the main things we're looking at. What are we going to get for our monthly income, whether we take it as cash or we reinvest it? So the other one I wanted to mention was BASE, Evolve Materials and Mining Enhanced Yield Index. Again, it just holds a lot of different mining companies from around the world. You get about a 9% yield. If you're curious about US Banks by Evolve or Global Materials and Mining Enhanced Yield by Evolve, I have a video that covers, I want to say it was, yes, ESPX. And in that video, it basically gives the entire fund structure from Evolve. And if you watch that video, you can apply the information you learned from that video when you go through all of these two Evolve ETF funds, if you're interested in that. Hopefully you like what you saw. And again, click all the buttons of like and subscribe variety, comment down below. Any questions you have, I'll be sure to respond. And with that said, I'll see you all in the next video.